In advanced economies and some emerging markets, government spending and borrowing have gone up for good reasons. Now that's intensifying discussions about what is the right level of borrowing for governments. Despite soaring debt, borrowing rates are declining and staying low. That leaves governments thinking maybe the fiscal cost of expansion is not that high. Maybe we can spend and do good things with that money without worrying too much. But are low borrowing rates good for fiscal sustainability? Should we expect low borrowing costs to prevail in the future? I am Ehsan Ibrahim, and I'm studying the decline in real rates despite soaring government debt. Debt is soaring in many advanced economies. At the same time, you see the rate at which governments borrow declining. Normally, when a government borrows more, investors ask for a higher interest rate, as they are worried about higher fiscal risk. But when government default is very costly, which is thought to be true in many economies, what can happen is that a government borrows more, leading to lower rates rather than higher ones. In this environment, we then see low rates. But in fact, this might mean that the fiscal risk is going up and not down. Low rates may not always have a benign interpretation. When government default is not very costly to the rest of the economy, the demand for government bonds will be as usual. If a government sells more bonds, it will borrow more and interest rates will be higher. That's all shown in the red line you see here. But when a government default is very costly, things might be very different. Take a look at this blue line. What can happen for a range of government borrowing is that the demand curve for government bonds is going to be different. Rates are going to go down as a result. So if we see low rates, as you see in that blue line, when the rates go down within the intermediate range of borrowing, it means that in fact the risk of default is going up. Also, as you can see, the borrowing rates starts going up beyond an inflection point. Whether the demand curve is going to be sloping like that blue line, the fact that government default is very costly is going to compress movements in government borrowing rates. In the real world, when we are looking at different country borrowing rates, even if they are going up when governments are borrowing more, they are not going up enough to raise the alarm. There is quite a bit of risk despite these little movements in government yield. In such cases, governments are borrowing more, but rates aren't going up as much, or can be even going down in the extreme cases. They just don't seem to be responding in the usual way to government borrowing. And that can be misleading to policymakers. Not only low cost of borrowing may hide underlying risks, but these costs remain low only up to a point, and they will start rising again. That leaves policymakers making decisions based on an understanding that may not be correct. These effects are more likely to be present if a government borrowing from the market already has a lot of outstanding debt. Another factor is the riskiness of other investments within the economy. Also, the stronger bank sovereign nexus, the more likely we are to see these impacts. All of these factors make government default more costly. But why is this happening? When you have more government borrowing, while government default is very costly, then we see two things happen. First, because a government is borrowing more, its economy will be riskier. Second, when government default is very costly, ironically, that makes government bonds a safe asset. The combination of these two leads to a lower yield on government bonds. The reason is that given a riskier environment, investors are going to flock to bonds looking for a safer investment. That then lowers the rate on those government bonds. It might be counterintuitive, but the key is that while government bonds become riskier as a result of more government borrowing, they remain the safer asset. All investment opportunities in this sort of economy will be risky, but among them, government bonds remain the safest possible option. What are the main takeaways? First, policymakers need to be aware that figures they are seeing may actually be misleading because the increase in the fiscal risk may be larger than what borrowing rates might suggest. And second, these low borrowing rates can start rising beyond a certain level of debt.